3,500 bombs set to be delivered at a time when the Israeli government is talking about going into Rafah. You can see why this would be deeply unpopular in the United States of America, given the devastation that's already happened in that part of the world and could continue to happen in weeks, months, and maybe even years to come.
Absolutely. And when the President of the United States is saying he does not want to see a full-blown invasion of Rafah, or really even any invasion of Rafah, even though we heard from the State Department saying that they have put proposals on the table. And Jonathan, you brought this up a number of times today. It is not unprecedented for an American president to be in this situation with Israel, even though it is rare. It doesn't happen all the time, especially when they talk about this ironclad commitment the U.S. has to Israel. Former President Obama delayed deliveries of missiles in 2014. Reagan halted a shipment of a type of artillery shell in 1982. Nixon held off on arms in 1973, and George H.W. Bush withheld loan guarantees in the early 1990s.
There's a deep history there. That's the latest on the Middle East. Here's the latest on TikTok. Taking the US government to court. Widely expected, not surprising. The parent company, ByteDance, is suing over the new US divest or ban law. The company claiming it violates the First Amendment. ByteDance has until January 19th to sell TikTok or face a ban unless courts intervene. This was widely expected, and ultimately, this is going to take a whole lot longer.
Whole lot longer, because also likely what's going to happen is the President of the United States is also going to extend that deadline to even 90 days. So this will firmly be in the hands of the next administration, whether that's Biden 2.0 or Trump 2.0, they'll have to deal with it. What TikTok is going to do is they're going to say this violates the U.S. Constitution, free speech. Also, Jonathan, some of their other arguments include it will hurt millions of small business owners who use the platform. They're really going to try to come at this from every angle possible. And I mean, the irony is not lost on you and I.
Shouldn't be.
When you look at how the Chinese government treats U.S. social media
We've
companies.
got to draw a distinction between ability and willingness. Clearly, this administration is willing to do something about these issues. Ability is a very different thing. Are they able to do anything about this? And can Chinese companies continue to use the U.S. system against itself?
Well, we'll have to see. This is going to come down to national security concerns. Does the U.S. potentially have to even show some concerns, some intel that right now is secure and they haven't been showing to the broader public? Will they have to potentially start opening up some of these books that, you know, you hear about, that they're briefing congressmen and women about? Potentially we'll hear about that. But Jonathan, I also go back to the fact that Rupert Murdoch became a U.S. citizen so he can buy the remainder of Fox. There is a reason why, for certain networks, you have to be an American citizen. They don't want this in the hands of adversaries.
This is the latest on TikTok. Here's the latest elsewhere. Minneapolis Fed President Neil Kashkari saying it's too soon to know if inflation progress has stalled. Kashkari telling the team here at Bloomberg, Carol Massa, Romain Bostic, that, quote, we're in a good place right now. The labour market is still strong. We can take our time to get more data to see if disinflation is going to continue. The Fed speak will continue today with Jefferson, Collins and Cook on deck, and a whole lot more still to come this week. Kathy Jones at Charles Schwab joins us now for more. Kathy, good morning to you. It's good to see you.
Good morning. Thanks for having me.
What are you expecting to hear from these Fed officials over the next few days?
Same old thing, patience. We're on hold. Things may or may not be moving in the right direction. We think they're moving in the right direction, and we're going to stay on hold for the time being and get more data.
You've got a different view on the data. Was the Q1 hot economy a bit of a head fake?
Yeah, the domestic demand numbers in Q1 were good, like 3.1%. That's where we've been for the last couple of quarters. But the employment data actually, with the revisions and with the latest numbers, were a little bit softer, I think, than people might realize. So not only was the payroll number last month below trend, we had some downward revisions. The work week was down. And we're seeing wage growth edge down a little bit. And you put all that together, and aggregate income may not be as strong going into the next several months as it has been over the past 6 months.
I know we were super eager to get to the weekend on Friday after payrolls, but the ISM services number was terrible. Going through the details of it, first contraction since 22, below all estimates in our survey here at Bloomberg. Business activity slumping to a 4-year low. Input costs growing in the wrong direction. What did you take away from that? How much weight do you put on a PMI like the one we got on Friday?
Yeah, I don't overweight it. I don't make it a real heavy part of my analysis, just because some of those surveys are diffusion indexes, so they kind of come and go. They're lumpy sometimes. But it wasn't good news, and I'm less worried about the price index as I am about the overall direction of trend in terms of activity, because I think that's probably a better read than the price index is.
What we've been trying to establish, and we've been talking about on this programme around this table for the last few hours, the last couple of days, the difference between a welcome cooling and an unwelcome deterioration. What's the line in the sand for you? How do you draw a distinction between the two things?
Yeah, it's the job market. If we start to see a big deterioration in job creation, a rise in the unemployment rate, or a real tailing off in terms of the aggregate hours worked, the work week earnings, that kind of thing, then I'd be concerned, because that would signal to me things are moving pretty quickly, and the labor market can do that. It can move pretty quickly.
How difficult is it to really understand this labor market when we have an incredible amount of immigration into this country? And also, when you look at the survey response rate, it's actually quite low.
Yeah, it's been a real problem. And the survey response rate has been going down over the years, but post-pandemic, it is really, really low. And I think we can expect a lot of revisions to the data based on that. Usually get revisions anyway because they get more data over the course of a couple of months. But in this case, it's even more likely to see some substantial revisions. And post-pandemic, everything's kind of thrown off anyway. In terms of the data, the seasonal adjustment factors haven't been working well. You know, you name it. So yeah, it is less reliable than it's been in the past, but it's what we have.
And how do you view this labor market really being able to handle all the immigration that has flown into the United States? Is there basically a lineup in terms of the workers coming in with the jobs the U.S. economy needs?
Yeah, I'm sure there's some mismatch, but the truth is that a lot of the jobs that we need are lower level, service sector jobs, healthcare in particular. We need people in nursing homes and daycare centers and, in these places. So a lot of these are lower wage jobs. A lot of immigrants come in and are willing to take lower wage jobs, even if they have more education or might qualify for something else. They do that because they need to work. And so I think, to tell you the truth, I don't think it's a huge mismatch. I don't think that this is a big problem for the economy. I think it's a big help to the economy to have people filling these jobs that are difficult to fill.
When John talks about the line of cooling versus serious deterioration, what are you looking at in terms of the Fed needs to see in the labor market in order to make that move of the first cut? Is it a 4.2% unemployment rate, or is it higher?
Yeah, I think 4.2 would really start to get them seriously considering the timing of the first rate cut, because we have come up from 3.4 at the low, 3.5 at the low, long period over 2 years under 4%. We tick above 4.2. If the other data are also soft, corroborating that rise in the unemployment rate, I think that would get them pretty seriously moving.
We've had questions about whether the rest of the world needs the Federal Reserve to cut so they can cut. The rest of the world's not waiting around. So we've heard from Sweden, they've cut. That follows the S&P. They've done the same thing. Citi's Andrew Hollenhorst says this morning. The Fed is unlikely to buck the global cutting cycle. Goes on to say that if either US inflation or activity slows, the growing rate differential between the US and other countries is yet another marginal factor that would encourage the Fed to follow the global trend towards lower rates. How does one inform the other?
Yeah, I mean, it's through the foreign exchange channel, right? We've had a very strong dollar. A lot of it has been driven by that widening rate differential. And so the dollar was starting to come down a little bit when we thought the Fed was going to cut, and we were building in 6 cuts. And then it took off again after the Fed sort of extended that timeline. And we see the pressure on the Japanese yen as a potentially destabilizing factor. We know Japan isn't too happy about it. So all these factors, I would say the dollar's on the margin for the Fed, but it's there, and widening rate differentials can create their own set of problems.
So you've gone through the framework for thinking about the economy, the global economy and central bank decisions. Let's talk about the menu. A 2-year at 483, a 10-year at 448, a 30-year at 462. What do you want to buy?
So we've been talking about extending duration for quite some time throughout this whole kind of upturn in yields. And the reason is, beyond just sort of locking in yield for the future and getting those cash flows, and we do think the economy slows, inflation continues to fall, but also the upside-downside risk-reward is pretty attractive. When you have coupons at 4.5% to 5.5%, the amount that rates have to jump in order to actually have a negative return is very high. If you just sit there, you're going to earn the coupon. If they go down, you're going to have that capital gain kick in. So when we look at that in terms of managing portfolios, the upside downside really favors being a little bit more duration.
Are clients still holding on to money market funds? Are they
sure.
listening? What would it take to unlock that?
Yeah, they're gradually moving out, but I do think, there's I think if you get the yields below 5%, we'll start to see people sort of migrate out. But right now, the short end is very comfortable. You can sit there for a long time and just, earn the interest.
It's why Chris Mamani was sat around this table talking about T-bills and chill. Still, Kathy Jones of Charles Schwab. Kathy, good to see you. As always, great to catch up. Thanks, Kathy. Let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Tesla shares are falling in the pre-market 3.7%. Reuters reporting that U.S. prosecutors are looking into whether Tesla committed securities or wire fraud by misleading the public about self-driving capabilities of its EVs. Tesla's autopilot systems assist drivers with steering, braking, and lane changes, but are not fully autonomous. The DOJ is examining statements by the company and Elon Musk that suggest its cars can drive themselves. Shares of Uber also down in the pre-market, 8.7%. The ride-sharing app missed on gross bookings and reported weaker than expected demand in LATAM. Uber CFO blamed tough comps, saying that last year captured higher demand tied to the return of Carnival in Brazil. He also pointed to earlier starts to holidays like Easter and Ramadan. Yet, both Lyft and DoorDash beat estimates, bringing to the fore questions about the strength of Uber and their market share in the U.S. Now, Panera Bread will no longer be selling its caffeinated charged sips drinks. The drinks, which infamously included an ultra-caffeinated lemonade, were the subject of at least 3 lawsuits, claiming that people who drank them were harmed or even killed. The drinks have up to 390 milligrams of caffeine per 30 ounces, which is about 4 times the amount of caffeine in a cup of coffee. Instead, Panera said it's going to introduce new beverages in the next 2 weeks, like a blueberry lavender lemonade. That's your brief, John.
Danny, thank you. If anyone out there has had one of those, can you reach out and let me know what it tasted like? Can I just go through those numbers again? Up to 390 milligrams of caffeine per 30 ounces, about 4 times the amount of caffeine in a cup of coffee. Have you ever had one of these?
No, but sounds like Tom's Tang.
Absolutely ridiculous. Up next on the programme, following the euphoria.
It is a relative game that we exist in, right? So certainly growth in stocks and equities have outperformed. And you want to own that growth in my mind.
We'll talk about some of the opportunities next in the equity market with equity futures near session lows. We're down about 0.4%. Going into the opening bell about 44 minutes away. From New York, this is Bloomberg.
With Greenlight, all kids can become champions with money.
With their government, with their future. But obviously, we are all concerned about it because the United States is the largest economy, the largest defense country in the world, and has been a beacon of democracy with all its upside and downside. We cannot interfere with their choice. It's their choice, and that's the beauty of democracy. But we have to be extremely attentive and anticipate, just as we do with inflation. We do scenarios. What if, what if, what if? Then what do we do? Where I sit now in Frankfurt, head of the ECB, I think that we have to be strong as Europeans and not assume that we can rely on whoever our friends are around the world, because these things change over the course of time, as we have seen.
Bloomberg. Context changes everything.
Let's get you the scores going into the opening bell. That cash open 42 minutes away. Equity futures pulling back by 0.4% on the S&P following 4 days of gains. Just a slight pullback. Yields a little bit higher by 3 basis points, 4.4876 on a US 10-year. Under surveillance this morning following the euphoria.
It is a relative game that we exist in, right? So certainly growth in stocks and equities have outperformed. And you want to own that growth in my mind. So there's always going to be opportunities. U.S. exceptionalism, it's making its way through the U.S. stock market. And I think that can be somewhat sustainable.
Here's the latest this morning. Stocks staging a comeback after an April slump. Sentiment indicators at 2 major banks faltering after that pullback. Citi's Levkovich index exiting euphoria territory, bringing a risk-reward setup to clearly bullish levels, according to Managing Director Scott Kroner. I'm so pleased to say that Scott is with us now for more, going into the opening bell. So, Scott, let's get to it. Your outlook, constructive with complications. Can we start with the complications?
Sure. The complications are that as constructive as we are in the fundamental setup for the S&P 500, we still have a number of macro overhangs and issues to contend with. Views of the pent-up effect of Fed rate hikes to this point weighing on economic activity and ultimately translating through to fundamentals. Obviously, where we are with the interest rate setup and influence on stocks, all of which gives us pause, but in a context here where we're increasingly constructive on the fundamental setup for the S&P 5 as we head into the back half of 2024.
That's the fundamental setup. Can we just talk about sentiment, which you allude to in that line that I read out aloud? Scott, where's sentiment now?
Yeah, so sentiment's always part of the puzzle, if you will. And as it turns out, our Levkovich index, which is our go-to sentiment read, had moved into euphoria right at the end of Q1. And in a pretty quick reversal versus history, it's come back out as we've moved through the bulk of the Q1 reporting period. So we're back in what we'd call a higher end of neutral, but you've taken some of that euphoria out of the circumstance. At the same time, what I'd emphasize here, Jonathan, is that when we use the sentiment indicator, it's usually in the context of other indicators. And our implied growth work also tells us that you've gone from a level headed into the Q1 reporting period that was going to be tough for corporates to surpass to something that also is more reasonable at this point in time as we move through the reporting period itself.
So some people, as you know, have been pushing back against earnings expectations, including your peer, Marko Kalanovic, over at JP Morgan. Could you just walk us through, just give us some insight into where earnings expectations are now and how they've evolved through the year so far?
Well, so we're at 245 full year for the S&P. We've been at that level, honestly, since last July. So we feel like as if our top-down sector-driven models have done pretty well for us. Consensus has moved up. We're right around 243, 244 right now. The way the Q1 reporting period set up was that we got a pretty clear beat, but a hold dynamic where your full-year consensus numbers did not move much. Now, this is not uncommon. It's very typical to see expectations come down into the reporting period, followed by a decent positive surprise. But the setup here, given what we know about the economic condition right now, is that we ought to begin to continue to see that consensus number lift marginally as we go into the Q2, Q3 timeframes.
And this is what I want to build on, the shifts in earnings that you anticipate later on this year and what that could mean for the big debate, I think, of the last 12 months, which has been large versus small and everyone itching for small to work. And then you get a series of head fakes after head fakes, and then small caps get hammered again. Scott, what's it going to take to get that more durable, sustainable shift away from large cap growth towards small caps?
Well, I think it's going to happen as a function of the numbers, right? So again, if you look at the setup here over the past year, your mega cap growth cohort, called the Mag 7, has seen their 2024 earnings expectations rise by roughly 28%. The other 493 within the S&P down 8%. Okay, we've seen some flattening in that other 493 number, and the setup, if you look at just the way the progressions go by sector, is that we should mechanically begin to see improvement as we go into the back half of the year. So we're looking for a broadening effect. We have been for some time now, fundamentally, that should augment what's been happening on the price side already. Now, here's where it gets interesting. We've been kind of coming at it from a Mag 7 versus other 493. We've also come at it from a sector perspective. But if you look at small versus large and value versus growth, The setup right now, as we turn the corner on mid-year 24, begin to look at 2025, should be a narrowing in earnings growth between those cohorts. So what you get here is a gradually improving fundamental setup in favor of small versus large and value versus growth, all of which in our view is quite healthy to the underlying market dynamic.
You mentioned 25. Scott, how difficult is it to develop a view on 2025 without knowing the outcome of November? How important is November?
It's really difficult. So we haven't got there yet, and that's usually what happens as we get into the June timeframe. So more to follow on that. But this is typically what analysts and strategists do: is you hit mid-year of one year, you begin to loop forward to the ensuing year. Now we've got the elections obviously coming up later this year, and we've been bucking them thus far, Jonathan, is sort of a tail risk. And right now we think the outcomes in either candidate or party are probably equity negative, but we've got a lot of room to go here in terms of policy positioning really unfolding as we get closer to November.
We're looking forward to seeing the work from you and the team through the summer. I just want to finish on this. I know the base case is 5,100. You've got a bull case as well of 57. Can we just talk about the bull case briefly? Are we moving closer to that? Because when I read the description of it, Goldilocks backdrop of soft landing, improving inflation, dovish Fed. Are we getting that?
In our view, we're getting close. I'd like to see those 10-year nominals come down. Again, we like to think of the 10-year nominals having an influence on how you price out the mega cap growth side. We want to see Fed funds coming down as a harbinger of, let's call it, the shorter duration parts of equities. Now, in terms of the soft landing playbook, that's still up in the air. House view is that we're still pointed towards something that's a bit more contractionary. But what I would say is that all told, we're feeling pretty comfortable that the macro influence is happening incrementally. It's not happening in a shock effect format, which usually triggers the bigger negative repercussion. So as long as we continue down this, call it, incremental path, that Goldilocks scenario sets up, whether it's second half or beginning at 25, is an open question. But again, fundamentally, we think the trajectory is still quite positive here.
Scott, it's been too long. Let's talk more often. Scott Cronin there of Citi, breaking things down in financial markets. Love the point on 25. It is so difficult to develop a view on 2025 when you have no idea what policy is going to look like. And given how policy-driven this market has been at times over the last decade, I think that tells you why it's so important. What he just said there, either candidate leans negative for financial markets, also tells you about how Wall Street feels at the moment about the options going into the end of this year. Coming up tomorrow, here's the lineup for you. BlackRock's Ross Kostrick, Sarah House of Wells Fargo, former World Bank President David Malpass, and Pooja Sriram.
To innovators everywhere, we're here for you. Highland's intelligent enterprise content solutions improve digital processes to spark more value for the people you serve. Highland, for innovators everywhere.
Policymakers and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
The shape of the On athletic shoe is unique. It can't be mistaken for any other brand. The structure of On's C-suite is just as distinctive, starting at the top with a pair of CEOs.
What we realized very early on is if you're adding different capabilities to each other and you do that as equals, then this leads to better outcomes.
Mark Maurer joined On as Chief Operating Officer in March 2013. Martin Hoffmann arrived as CFO that July. In 2021, they jointly assumed the CEO role.
We are a brand that needs to be excellent in designing product, in innovating product, but also in shipping millions of parcels from A to B in the most efficient way. So we need to have very different mindsets and very diverse people. Mark has different strengths, I have different strengths, and if you take us together, you just get more.
Companies with co-CEOs are rare, but On's configuration is even more unusual. Martin Hoffmann also holds the CFO position. He says his two jobs complement each other.
I actually feel the CFO makes you a better CEO and the CEO makes you a better CFO. Understanding what you build as a CEO helps you to understand your numbers, and understanding the numbers helps you what are the right things to build.
every single thing I've done, it's almost as if somebody has said it can't be done. I mean, I remember I was in a factory and I said, I want to go in the night shift. And they said, no, we don't put women in the night shift. I said, how will I be a successful production manager or personal manager of a factory if I never went into a night shift and knew how a third of my people worked? So in some ways it has fueled some of my determination. It's fueled some of my, okay, I'm going to show this is possible, a sense of I'm going to go get on and do it. It also gives me courage because I feel sometimes I'm not just doing it for me, I'm doing it for everyone else who comes after me. And I always tell women who ask me for advice saying, put your hand up for the most difficult job. Put your hand up for things that are challenging. You know, go in there and lean into things that are difficult, that are challenging, because that's what gives you the greatest credibility, respect, reputation.
From New York City, for our viewers worldwide, a very good morning. I'm Manus Cranny in New York. So tech is the challenge to this equity market rally. It pauses. Nobody likes mediocrity, and that is what Intel gave you in terms of the guidance. Sub-midpoint. Not good enough. We'll count you down to the open, big tech and beyond. Coming up on the show, those futures move lower after 4 consecutive days of gains. Investors search for a catalyst with the earnings season wrapping up. And the Fed conundrum continues as Jefferson, Cook and Collins take to the stage. We begin with the big issue. The rate debate rages on.
The bar for additional rate hikes is extraordinarily high, right? Really, really high. It really does, it does not suffice to have inflation continuing to be stuck. And that is essentially what's been happening since June last year. As much as we got excited and as much as we exaggerated at the beginning of the year in terms of our dovish expectations, I think the market is now exaggerating on the hawkish side and is sort of treating this as if the world has changed upside down and is entirely different now, even though nothing really has changed on the inflation side.
The bar is extraordinarily high for a hike, according to Max. Mike McKee joins me now. Plenty of Fed speak, which can either qualify that high bar, Mike, and help us understand a little bit more about Fed thinking. Good morning.
Good morning. Well, we've had a lot of Fed speak over the past week, and all of it pretty much confirming the idea that the bar is very high for a rate increase and also still high for a rate decrease. These are the people who've spoken so far. The higher for longer club, all of them, the 4 of them, Powell, Williams, Bowman, and Barkin, all voters this time. Next on deck, we get Jefferson, Collins, Cook, Daly, Logan, Harker, Mester, and Bostic over the next 2 weeks. So a lot more to come, but they're all singing The Beat Goes On. There's an earworm song for you. And basically, after we have all this now, we have all of the major banks making their calls, and pretty much J.P. Morgan is and Goldman Sachs are the only ones who are on the earlier side of it. Morgan Stanley moved their call today out to September. Bank of America, Deutsche Bank still thinking December. Now, one of the things that's happened because of all this higher for longer talk is it's helped the markets as the U.S. goes to market with a lot of debt. Fundamentals or demand? The 3-year yesterday, good bid to cover ratio, stopped through a little bit. 10 years are up today. Last time they went out with a 2.34 bid to cover ratio and indirect bidders of 61.8%. We'll see if it's still as attractive or less so. Right now, what it's looking at when you look at the when issued is that we might see a bit of a tail, according to analysts, although right now running below so far, running above, rather, the when issued is running above the on the run. So at this point, we will see whether we can get through these auctions okay, even with yields lower.
Okay, Mike, let's see how the auction goes today. As you said yesterday, the threes went very, very well. In conversation this morning, we have SocGen's Subhadra Rajappa and Charles Lieberman of Advisors Capital Management. Just to reflect for a moment, you know, Deutsche Bank with me this morning saying the bar is so high, exceptionally high to a hike. But I put it to you that Kashkari yesterday didn't rule out hikes. He reopened Pandora's box and he questioned the restrictiveness of the Fed's current position. Can we just square away how left of a left tail risk a hike might be? Subhadra, good morning.
Good morning, Manus. So I think that the bar is still very high for the Fed to hike rates. And I would say if there's one big takeaway from last week's FOMC meeting, it's the fact that Powell pretty much shut the door on the potential for a hike. I think they want to be patient. They want to be careful on policy, and they want to keep policy rates higher for longer. But I just don't see them hiking rates, especially in an election year. And there's also no precedence historically, I'd say, in the last several decades of the Fed pausing rates and then hiking rates. So I think they're just going to keep policy higher for longer and wait for that impact to be felt through the broader economy.
The question, though, that we must debate is the long of, how long is the longer? Adam Posen with me last week saying that Powell had boxed himself in. Charles, a very good morning to you. You decided to go leap backwards beyond the jobs report and go back to the ECI, so you're firmly entrenched on the hot print in the ECI. Does that confirm the longer for you rather than the wages temperance that we saw on Friday?
Hourly earnings number, which is less accurate and it bounces around a fair amount. Employment cost index is a more accurate number. Unfortunately, it's only available on a quarterly basis. So my sense of it is that we do have a tight labor market. The economy is growing at a very solid clip. I'm very much in the higher for longer camp. And I think it's premature to rule out that the next move is a rate hike. The bar is very high for a rate hike. But if we don't see much progress on inflation through the balance of the year, I expect the Fed to leave policy unchanged over the course of the year. And then we open the door to the possibility they need to do a bit more to slow the economy down a bit more in order to bring inflation down.
Charles, you just want to have a little bit of the hedge in there. You just don't want to close off that left tail risk. So, Subhadra, let me take it back to you, because since the FOMC, we've had a fairly nice run. We're sub 5% on the twos. We've had a 22 basis point drawdown on 10 years. My question is, that bullish run, some people have said to me, it's a recalibration. Is that recalibration hitting the buffers? Is this as much recalibration as we will get until we get the CPI?
Yes, I think the focus is all on the CPI. If there's one day you want to show up to work, it's CPI day, because you see the most amount of volatility in bonds on the CPI day. So really the focus, at least for the next week, is going to be on CPI. We do get supply this week. The refunding supply, I think, will get pretty well absorbed. But for the most part, I think that yields are going to hover around that 4.5% level till we have confirmation on the data front. I think it's too soon for the markets to get too dovish, because we've had 3 hot CPI prints. We have to see what we get next week.
A nice bit to cover on Subhadra, a nice bit to cover on the 3-year auction yesterday. If I ask you to describe how the street is absorbing and demanding paper in these auctions as we go into this week, how would you frame that?
So typically you tend to see pretty good demand for refunding auctions. The first issue tends to be well subscribed. We have seen tails in the 10-year auctions. For the most part, a lot of this demand is coming from domestic investors, as well as some of the foreign investors. The investor base in general wants to hold on to on-the-run issues. So we tend to see refunding auctions go quite well.
And Charles, to you, in terms of these auctions, how important are they as a litmus test for tolerance as we go into what's going to be a beginning of the slowdown as we go into the June season? So how important is this, that demand is strong, demand is firm, and that there is no wobble in these auctions?
Well, it's important that demand is firm, but I don't think the auctions are the make or break for the market. I think it's far more important how the inflation numbers look. If the inflation numbers look troublesome, then we're going to see a pretty bad puke in the bond market, even if the auctions go well.
What does a bad puke look at? I mean, we talk about the biggest component part of the CPI being rent. You make it very, very clear. I mean, rents are about a third of the CPI. You have your concern around that rent component. So quantify a puke for me, and in terms of the rent, they're pretty lofty.
Well, rents are a big part of the CPI, but they're less in the personal consumption deflator, and that's what the Fed is focused on. What I really care about is non-rent services. That's the part that has more inertia. It is probably not coming down as much as the Fed would like. In fact, it's definitely not coming down as much as the Fed would like. The problem is the labor market is very solid, very strong, and so labor costs are rising. And I just don't see an end to that quite yet. That's why I think it's unlikely we're going to see any more rate cuts this year. And that story will change if the data changes, and I just don't see that.
Can I ask you both your current and your forward perspective on immigration? It's a hot political topic if you're a border politician. As far as economists are concerned, it's a quasi-lid on wages. So, Badr, to you first of all, this to me is now beginning to read as a long-term 2025 issue for whoever. It's either a Biden Mark II in the White House or it's perhaps a Trump administration. Either way, immigration will be a hotter topic, both up to the election and in reality in 2025. So is that a more prescient issue for the bond market then? We have a long lead time before immigration perhaps plays into the bond market in significant size and a cap on the immigration numbers.
So I think there are many aspects to the immigration story, right? One is the fact that they're seeing a higher entrance into the workforce, higher perhaps, participation rates. The other aspect is you're seeing some pressure on wages because the new entrants are potentially keeping wages down, especially for the low-wage earners. But over the longer run, I think immigration is going to be a positive for the U.S. economy in the fact that you have more entrants, more services side jobs, and some of the constraints we're seeing in the labor market are going to be less constrained given the fact that we have such a shortage of services side workers. And I think that the immigration story is going to be a positive one for the decades to come.
Okay, and to you, Charles, again, your perspective on the immigration side. It comes up every now and then, especially when we see the debate around wages and the kind of immigration that we have in terms of the kind and type of jobs that they are trying to find.
Well, immigration helps promote economic growth. So you have more people, more consumers, more workers who get employed, have more income to spend. So it definitely contributes to economic growth. But at the same time, it's also providing a lid on wage inflation, especially for lower skilled workers, which is where a lot of the immigrants are coming into, that part of the labor market. And that part of the labor market has actually seen more upward pressure on wage rates than the higher income workers. So it's very helpful that the immigration is coming in because it helps tamp inflation down. The question is, does it change if immigration policy changes? If we start putting up some barriers at the borders, we're going to see a tightening of the labor market very, very quickly, and that will create some wage inflation and price inflation issues.
Let's just square it all off in terms of choice. Lots of people are saying clip your coupons, but of course you want to be prepared for those insurance cuts. Sabadra, where on the curve do you want to be? We're down 22 basis points from the highs last week. Where would your choice spot be on the curve?
So that's a tough question. I would say that for the most part, we've been kind of long the belly, especially with the sell-off that we saw a few weeks back. But, the belly has outperformed relative to the wings. 5-year especially has outperformed on the curve. So, I think where it stands, I can't say that there's any sort of interesting opportunities on the curve. For choice, I think that the front end, especially given how high yields are, it makes sense for investors to continue to plow their money into shorter dated investments because returns do look attractive on a duration-adjusted basis.
Okay, Subhadra, thank you so much. Subhadra Rajapal and Charles Lieberman setting their stall light on the market. Quick snapshot of what's going on in dollar yen. This is the other major discussion in markets today. It is, of course, the jawboning from Ueda. Now, this market is challenging the Bank of Japan's narrative, where he says one-sided weak yen is a negative for the economy. They've got the right to raise rates. Talking about a monetary policy response to the weakening of dollar yen. This is a big turnaround for Ueda. As you can see, the market is really pushing back against the verbal intervention by Ueda, and that is critically important. Dollar yen, and again, retail investors are now selling yen, and they are some of the biggest players in that market. 3 days, and jawboning simply is not working by Ueda. You don't get bang for your jawbone anymore. Let's get a little bit more breaking news. Abigail Doolittle has that for me from Bain.
We do have breaking news regarding Bain. There is a report out from the Wall Street Journal that Bain is considering taking PowerSchool, the cloud-based software company for schools and education, private. This stock is now soaring up about 25%, 23% right now. Into today, down about 29% year to date. There is an 8% bearish short interest. So much of this squeeze. But again, the breaking news is that Bain is in talks to take PowerSchool private. As for Uber, we do have the shares lower. This, of course, after they posted a 32-cent loss as opposed to a 25-cent profit in their first quarter. The first quarter gross bookings also missed on a mobility miss, up 81% over the last 12 months. Investors wanted more. They wanted the company to at least meet, and that did not happen. Now, Intel, these shares are down 2.4%. This is interesting because they have essentially pre-announced to the downside for the current quarter after bringing that guidance down just 2 weeks ago. They're saying that this has to do with being informed by the U.S. Commerce Department that it was revoking some of its export licenses to Huawei. So that stock down 2.5%. And then Tesla also down 3.7%. The DOJ looking into whether Tesla misled investors, consumers about its EV self-driving capabilities. This, according to Reuters, Manus.
Yeah, and just on that news, we had, of course, Qualcomm as well, and they're doing much less business with Huawei, but the stock is still down 2% ahead of the open. Abby, thank you very much. Rounding up the breaking news. Coming up, the White House sends a message to Israel.
If you're going to conduct a military operation, you want to see people evacuated, but those people need to have somewhere to go. And we have not yet seen a plan that would deliver that.
The U.S. pausing a shipment of arms to Israel amid concerns about the potential military offensive on Rafah. That conversation next with Bobby Ghosh, right here on Bloomberg.
Building your online business? Go to Wix.com and set up your store on a single integrated platform. Add products, showcase them dynamically, and seamlessly track your inventory. Accept multiple secure payments, and design your storefront down to the very last detail. Get all the tools you need. Drive more sales with customizable gift cards and flexible product subscriptions. Retain customers with a point-based loyalty program, email automations, and reach millions with sales channel integrations. Complete your setup with a personalized analytics dashboard. Make smart business decisions and shape the next phase of your business. Build, manage, and grow from one place. Go to Wix and launch your online business today.
Ukraine and Gaza, it's in many other corners of the world as well. But I'm constantly surprised by the level of resilience and the capacity to actually bounce back from those traumas. So I have faith in the human beings and their capacity to respond to adversity. We've seen it. You know, look, earlier in the pandemics, we thought that the world was coming to an end, right? It hasn't. Nobody thought that vaccines would come up in such a short period of time. And every time we have to constantly resurrect this spirit of resilience.
But are you hopeful that
I'm always hopeful. Oh, come on, we have to be. We have to be.
Bloomberg. Context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg. Context changes everything.
It's no secret that they want to conduct a major military operation there. We have made clear that we oppose such an operation. If you're going to conduct a military operation, you want to see people evacuated, but those people need to have somewhere to go. And the place that they go to needs to have sufficient food, sufficient water, sufficient housing, sufficient sanitation, and we have not yet seen a plan that would deliver that.
The White House deciding to pause a shipment of 2,000 bombs to Israel. Now, this is over the concerns about a potential military offensive on the city of Rafah. The U.S. is concerned about the damage the bombs could do to the city, where over 1 million Palestinians are currently sheltered. Bobby Ghosh is with me. Bobby, the size of these bombs, a 2,000-pound bomb, a 500-pound bomb, is being held up. Do we understand what scale or what impact that this pause in delivery would have on the artillery of the Israelis?
Well, no, the short answer is no. We don't know the state of Israel's stockpile of these weapons. Do they have enough? Will the withholding of, I think it's 3,500 of these bombs, will this withholding have a serious, make a serious dent? We also really don't know how much of this Rafah operation is to be conducted from the air, and therefore how badly the Israelis need these bombs. But it's not really about the numbers, it's about the signal. This is the first time the Biden administration has pushed back on something like this. It has been a long time in coming. There have been plenty of people pressing Biden for weeks and months now to hold back American weapon supplies, even from within his own party. The fact that he finally went ahead and did it is a display of displeasure that I think we just heard from his spokesperson there. I think the administration felt like they were not being listened to by the Israelis, that their concerns were not being addressed by the Israelis. And this is the administration pushing back and saying, you know what, if you don't listen to us, there have to be at least some consequences.
There's also been a huge, significant demographic tone change here. Campus, universities, pushback and protests have been escalating. The images to the world have been very, very clear. If you look back in history, I mean, we've got Obama, Reagan, Nixon, all holding back in various forms. Can you put context around the scale of this holdback by Biden relative to other presidents? Is it a piece of theater, or is it more significant than that, given the domestic pushback?
Well, they're very different strings that Biden is having to hold in his hands and keep control of at the moment, to your point, which is that he has domestic opposition, not just from within his party, but in the streets of every campus practically in this country. He has, despite those protests, he has in his rhetoric continued to be very pro-Israel. He has said over and over again that his support for Israel is unshakable. On the other hand, he needs Israel to show him that it is paying attention to his concerns. And his concerns have been very clearly articulated. They're not saying Israel should not conduct a military operation. The administration is saying Israel should first make provisions for civilians. This does not seem like an unreasonable request or a demand. And the fact that the Israelis have not apparently taken that on board required a response. And as we said, in terms of actual impact on Israel's ability to conduct its military operations, this may not amount to a big hill of beans. But it sends a message to Israel, and it sends a message to the wider world as well. And it does send a message to those campus kids who are protesting that the Biden administration is not just simply saying yes to everything Israel wants, that it is holding back. Whether that persuades those kids in the campuses, whether that persuades international opinion, that's a different matter. But Biden is trying to thread all these needles simultaneously.
Very delicately. I think the last time Obama held back on missiles for several weeks, that was 2014. As Bobby just said, we don't quite understand the scale and the impact on Israel, but it's the messaging that counts. Bobby, thank you so much. Bobby Ghosh. Let's stay in the world of politics. TikTok's parent company, ByteDance, suing the US government, setting up for a long court battle between the two sides. We've got Jackie Davalos with me. So TikTok's argument in this legal challenge, I'm curious to know what it is, because this is going to be whoever's in the White House, possibly in the new year, may well have to deal with this.
That's right, Manus. And if there's one thing that both sides of the aisle can agree on, is that free speech is one of our most revered rights here in the United States. And that's exactly what TikTok is arguing, that the law that would effectively ban the app from operating in the United States violates Americans' right to free speech, to express their views and post what they please. Now, there's a few other things that we learned from their legal filing yesterday. We learned that they believe Congress did not provide adequate proof that the app actually poses the national security threat it says it does. They also said that their efforts to fence off data, which, as you remember, was actually done through Project Texas. It was a $1 billion initiative to basically fence off data, moving them to Oracle's servers. And that those efforts were ignored. So ultimately, this is going to play out through the courts and probably make its way up to the Supreme Court.
Okay, we've still got Mnuchin salivating at the possibility of getting his hands on it. Jackie, thank you very much. Jackie Davalos there on TikTok. Coming up, your morning calls from Intel to Uber. Disappointing results on the tech side, throwing cold water on your equity rally. Uber down 7%. TripAdvisor absolutely tanking, down 31% on Bloomberg.
Machine learning offers the elimination of a lot of drudgery that then frees up people to go tackle these bigger problems.
DOJ or other authorities.
Could face bigger challenges next.
It was going to keep Green World Cup.
This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond. Morning calls for you. BTIG resuming coverage of Lululemon with a buy rating. A compelling valuation, they say. Needham adds Reddit to the conviction buy list, noting a robust business model. And finally, Barclays downgrades Victoria's Secret to underweight, highlighting the competitive landscape. Coming up, Burns McKinney joins me on stocks.
Top names in global leadership are on Bloomberg.
The ultimate goal of doing away with the central bank still stands. The discussion regarding the central bank is primarily moral in nature. The way we see it, there has been a cultural change in Argentina. Today, wages are miserable, not through our own fault. That is due to 20 years of populism. Argentines have understood that populism is no solution, and that the quick fixes they sold to them during the last 100 years, both the criminal politicians and criminal economists, they were all false. And we need to opt for a pure orthodox market-based solution. And that's what's going to make us succeed. And that's what's underway. In fact, there are already indicators today that show that activity in the agriculture sector, in the oil and gas sector, in mining, well, our economy is recovering strongly in those departments. There are indicators that point to the fact that Argentina could really make a strong comeback.
Nobody covers the top global leaders like Bloomberg Television and Radio. Context changes everything.
If you can dream it, then bread provides, yeah. Cause bread loves everyone, and it's the type of journey that should be fun. The life you always wanted, time to make it true, cause you deserve it, and bread is the one for you. Bread Financial, the best thing since online banking.
Introspection. Just look at Uber at the bottom of your screen, down 8.55%. We're waiting for it to roll over in the opening of the cash. A lot of these tech stocks are really beginning to sort of deliver guidance that's shaking the foundations. Intel delivering below the midpoint on a new government move to block them supplying chips. There is the opening bell. Stocks are lower. We're pausing on this rally that we've had for 4 days. Let's see where we end up for the rest of the day. This is the shape of things in the rest of the market. Completely unimpressed by Ueda's intervention, verbal intervention. The Bank of Japan governor sending a warning shot that monetary policy may be needed to respond to exceptional moves in the FX market, and still the dollar is higher versus the yen. Retail investors are selling the yen. Yields are up by 2 pips at the moment. You've got there again a narrative higher for longer. A whole host of Fed speakers will be coming. Jefferson, Cook and Collins, to name but a few. We're down 22 basis points from the Fed peak last week. And crude is down 0.9%. Stockpiles are rising. Cushing up by more than 1 million barrels last week. That and a little bit of a question about global growth is unsettling the oil market. We've talked about Intel delivering a mediocre guidance. The chipmaker warns that the second quarter revenue will be hit by the news that the US ban on chip exports to Huawei. Abigail Doolittle is with me. It's a double blow, really, for Intel, isn't it, in a number of weeks?
It is. This is interesting. To my memory, it's pretty rare for a big company like this to guide down twice in just a couple of weeks. But a few weeks ago, when they reported, they did exactly that for both earnings and revenue. Revenue of $13 billion was about 5% light of what the street was looking at. And so now, as you mentioned, the range, $12.5 billion to $13.5 billion, they're saying that they're going to be in the low end of that. So it really is a double guide down in some ways. Investors seem to be taking it somewhat in stride, though. The stock down just 2.2%. If they had given a really bad guidance all in one earlier, it could have been a much bigger blow at that time. But the cause, perhaps they have a good excuse, a good reason for this. And of course, that is the U.S. government basically banning Intel and Qualcomm from selling some of its chips to Huawei as they investigate a particular, I think it's the 7 nano chip in one of their phones. The interesting thing about it, though, is, Manus, I use the SPLC function in the Bloomberg terminal, and just 0.13% of Intel's revenue is from Huawei. So it's still hard to know how much this is of an impact on their actual revenue. It will be of that amount. Maybe they see ripple effects. This stock on the year right now down 39%, and that's not even the worst year in a long time. In 2022, it fell 49%. So Pat Gelsinger really has a lot ahead in terms of manufacturing the turnaround he's been talking about.
Yeah, certainly that foundry business has not exactly delivered as was originally anticipated on the program. Abby, thank you very much on the Intel stock. Let's stick with the earnings. I mentioned Uber posting weaker than estimated gross bookings. It's a different story for Lyft, of course, moving higher after topping estimates. Jess, draw the difference for me.
Well, good morning, Manus. It's basically a tale of two different stories here when you are looking at these ride-hailing firms. I'll start off first with Uber. If you look at that stock down about 7% now just after the opening bell. So it is on pace for its worst day since October of 2022. The big miss here, though, when you're looking at this is actually first quarter gross bookings that miss estimates. Also, if you look at the second quarter as well, just coming in shy of those expectations. So if you look at Uber's company, they see gross bookings around $38.75 billion to $40.25 billion. The estimate was around $40 billion. So that midpoint range just coming in shy of those analyst expectations. So the big thing coming up when it comes to Uber is it is integrating its Uber Eats interface into the Instacart app so it can fulfill those sort of restaurant orders placed by customers there. If you look at the A&R function right now, though, 7 buys, 33 holds, and 2 sells. But moving over, looking at Lyft stock this morning, it's actually up about 5%. So it's on pace for its best day just in about a week there. But when it comes to Lyft, this is a bit of a different story because it doesn't have different segments, say, like Uber Eats when it comes to Uber. So the big thing is about margins and then also cost-cutting controls. So when it came to CEO David Risher, who took over about a year ago, it's been through extreme cost-cutting efforts over the last year, so cutting costs by about 13% in 2023, and then also it narrowed its net loss by nearly 80% last year. So when you are looking at this, it's really more of a cost-cutting expectations that's really boosting Lyft stock, especially when you're looking at this and basically analyst expectations, more favorable outlook when it comes to gross booking. That is a little bit of a different story than when you are looking at Uber, Manus.
It is, but a brutal day for that Uber stock today. Jess, thank you so much. Turn to social media. Reddit jumping in its first earnings report since becoming a public company, posting better than expected quarterly sales. What was under the hood? Ed Ludlow is with me to take us through this. So a pretty glorious set of results, and it's all about monetization of the platform, isn't it, Ed?
Yeah, that is right. And we can get into the sort of strategy going forward. What's interesting, the stock's up 4.6%, 4.5% as we speak. It had actually opened up 12%. So that initial euphoria has kind of cooled off somewhat. 48% top-line growth in the March quarter, revenue coming in above expectations, $243 million. The street was looking for $212 million, and the guide for the current period, which ends in June, also above expectations, which is interesting. In an interview, Steve Huffman, the Reddit CEO, basically said the next phase is to improve a pretty young advertising business, which seems to be doing well. A lot of the sell-side reaction was like, okay, the ad environment's good, what's next? And, you know, you're familiar with the Reddit forum and how it works. One strategy is to tap into making it more almost e-commerce focused. Mm-hmm. There are existing ways that Redditors can make money through sort of digital gifts, avatars, or doing transactions between Redditors. The question is, how does Reddit make money out of that? And they are thinking about that. And then there's the AI data licensing business. We actually didn't hear that much about it, right? So they have this sizable agreement with Google where they can use Reddit data and content to train Google's large language models. But what's the next iteration of that? Like, who are they going to sell it to? Fortunately, we get another opportunity to ask the question because Reddit CEO Steve Huffman's going to join me on Bloomberg Technology at the top of the 11 a.m. Eastern hour. But that's the question. They've always struggled with profitability, but I think a lot of investors see a way forward if they can diversify their revenue streams.
Yeah, well, it is about creating communities that remain sticky. Thank you very much, and we look forward to that interview. As Ed said, the CEO, Steve Huffman, will be with Bloomberg Technology, 11 a.m. Eastern. Steve Huffman, not Hoffman. Okay, turn to travel. TripAdvisor said that they've got a special committee, and it determined that there is no transaction with a third party that is in the best interest of the company and its stockholders, and the market does not like this by a long chalk. Isabel.
By a long shot, indeed, Manus. Shares are edging lower by 36%. This is the lowest level since November 2023. And it's really exactly that a special committee said that there is no third party that is in the best interest of the company. And also, TripAdvisor also reported a worse than forecast loss. So this special committee was formed in March, and they said they will continue to evaluate offers. Bloomberg reported in March that there are some companies interested in taking over. One of those is Apollo Global Management. And for now, investors aren't really liking that. They seem to be on edge. edge. Also, the company reported adjusted EPS that's 12 cents. That's higher than the 5 cents estimate. So this is good. The company's revenue also hit $395 million, which is 6% increase year over year. Also good. But again, it was overshadowed by the concerns of the sales performance. So this performance of TripAdvisor really just highlights how competitive the travel industry is. And it remains to be seen where the company will be heading here on out. But for now, shares are lower. And year to date, it's not looking good also. Shares are down 20%, Manus.
Isabel, thank you very much. And they've actually just halted, as you were speaking about the stock there. TripAdvisor has been halted after the stock dropped by 36%. So circuit breakers and a pause in trading on that. My next guest writes this. The impact of higher for longer rates is that it benefits shorter duration investments, and this could be a catalyst for value equities and dividend growers. Burns McKinney is with me, Senior Portfolio Manager at NFJ, joins me now. Burns, we'll come to that value and the dividend narrative in just a moment. There's multiple headwinds coming in here this morning from Intel, a double warning, from Uber not doing as well. TripAdvisor has just been halted. It's almost as if we've sort of run into a mini barrier on this sort of nice 4-day rejuvenation streak. That's to be expected. Volatility is something we're just going to have to get used to.
Well, with interest rates as high as they are, we should expect volatility. But I think what we're also seeing an example of is the fact that this has been a fairly solid earnings season. I think basically 4 out of every 5 companies have beaten earnings estimates. We don't have a lot else going on in the news right now, but this has also been a season in which those that have missed earnings have been punished by worse, and those that have exceeded earnings have been rewarded a little bit less. And specifically within that, the tech space, the consumer discretionary space, have been some of the areas that have been you've seen names most punished when companies have missed earnings. And that's really probably, as much as anything, just an example of just the overall equity markets being just a little bit stretched.
Yeah, I mean, they are, and I think they're going to need another catalyst. I mean, the earnings were supposed to fill the gap. The earnings were supposed to fill the gap if there was no rate cuts. Now we've got a couple of rate cuts potentially penciled back on the slate again. I want to understand, your proposition is that maybe it is time to get more enthusiastic about value relative to growth. If I look at growth, it's had a heck of a run. What kind of discount is value trading to growth at the moment?
It's almost double what your historical discount would be. On the base, just as a result of the fact that the U.S. value index trailed the growth index by 30 percentage points last year. Typically, when you lag by that much value to growth, value equities have outperformed about 3/4 of the time over the subsequent year and a half. And as a result of that lag, the price to earnings multiple of that value index is trading at almost a 50% discount to its growth index. And typically that's probably about a quarter discount. And it's not just over the last year. The value benchmark has lagged growth names by about 6% per year over the past decade. Now, obviously, you say, well, what is going to be the catalyst for sort of a reversion to the mean? And equity interest rates being higher for longer could in fact be that. That tends to reward shorter duration equities. The way we sort of think about value stocks, for those viewers who've seen the movie Office Space, there's a character Milton that just watches everyone get birthday cake but him. And in many ways, that's what the value investors have been. They haven't gotten cake in a while, and we do believe that the time might be coming pretty soon for those value stocks to get a little cake.
Well, somebody else who'd like a bit of cake are the small caps, I'd say. If growth is supposed to be so robust and the economy's strong and the consumer is grand, I know there's a few cracks on delinquencies, et cetera, but it's nowhere like pre-GFC is what I'm told from a number of guests. What about small caps? Because I'm being told they've got high floating rate debt, they've got a challenge in profitability, but you're a bit more of an evangelist and a believer.
There's definitely some opportunities for stock pickers within the small cap space. If you look on a price to book basis, small caps are trading really at a discount to the market that we haven't seen since 1999. And that was a time that ushered in about 10 years worth of small cap outperformance. So you've got the discount, you've got the fact that small caps overall offer above average earnings growth. And so there definitely can be some opportunities there. That said, if we do slip in a recession, then the small cap area as a whole will probably be hit disproportionately hard. And so investors do need to not necessarily buy that small cap market as a whole, but rather be a bit choosy.
I was just looking at the buybacks that have been announced, and Goldman's run their own analytics on it. $930 billion is what we're expecting for 2024, and a bulk of that has been done, but there's more to come in May and June. Can buybacks create the floor alongside 2 rate cuts and steady growth in earnings? I mean, that's a pretty good trifecta on a stool for me.
Yeah, that's 3 great legs to the stool. We like the fact that companies are generating a lot of free cash flow, the fact that they're returning that to shareholders. Those buybacks are definitely a solid support for the market. And really, we suggest a lot of our clients should even focus more than that on companies that are paying and raising dividends, because buybacks can come and go, but companies tend to be low. They tend to really be averse to cutting their dividend payments. And when they raise those dividends, those are really kind of the sweet spot of a market, especially when you're trying to keep up in an inflationary environment.
Okay, we're just seeing a small tick up in yields this morning, so that breathless rundown on yields over the past 5 days is pausing as well. NFJ's Burns McKinney, my guest this morning on the markets. Coming up, Apple gaining ground on China.
Apple is missing is AI capabilities, and that is something some of these China vendors are starting to show. China also has a leg up in the sense that they are releasing more and more foldable phones out there, which the consumer likes. That's something Apple does not yet have in its pipeline.
Chinese iPhone shipments jumping 12% in March. That conversation still ahead on Bloomberg.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key. You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper.
I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Welcome to the world of